Want to know the top 5 investment strategies that can help you grow your wealth? Well, you're in the right place. Today we'll be exploring the fascinating world of investment strategies. These are the roadmaps that guide us on the journey to financial growth and stability. They are the key to unlocking the potential of your hard-earned money, and they are as diverse as they are intriguing. From hunting for undervalued stocks in the style of value investing, to seeking out companies with high growth potential, there's a strategy for every investor. We'll also delve into the steady stream of income offered by dividend investing, the cost-effective approach of dollar-cost averaging, and the wide market exposure of index investing. These methods have been used by successful investors worldwide, and today, we're pulling back the curtain on them. Ready to dive into these strategies? Buckle up, and let's get started. First off, we have value investing. This strategy, my friends, is akin to hunting for treasures hidden in plain sight. It involves buying stocks that appear to be trading for less than their intrinsic or book value. It's like finding a diamond in the rough and polishing it to reveal its true worth. Now you might be wondering, how does one determine if a stock is undervalued? Well, a value investor scrutinizes a company's fundamentals, including earnings, dividends, and sales. They also consider the company's competitive position, its industry dynamics, and even the overall economy. Essentially, they are looking for stocks that the market has overlooked or underestimated. But of course, like every investment strategy, value investing comes with its own set of pros and cons. On the bright side, it offers the potential for high returns as the market eventually recognizes the true value of the undervalued stocks. It also provides a margin of safety as these stocks are often less susceptible to market volatility. On the flip side, value investing requires patience, a lot of it. The market may take time, sometimes years, to adjust and reflect the true value of the stock. Moreover, there's always the risk that the stock is cheap for a reason and may never reach its estimated value. An excellent example of a successful value investor is none other than the Oracle of Omaha, Warren Buffett. He is renowned for his ability to spot undervalued companies and hold on to them until their value is fully recognized by the market. His strategy is proof that value investing can be successful, but it requires a keen eye for detail, a deep understanding of the market, and most importantly, the patience to wait for your investments to bear fruit. So, there you have it. Value investing can be a goldmine if you have the patience and the eye for undervalued assets. It's all about buying low, holding on, and eventually selling high. It's not just about the numbers, it's about recognizing potential where others don't. And who knows, with a bit of practice, you might just become the next Warren Buffett. Next up is dividend investing. Now, let's dive into the world of dividends. Dividend investing is a strategy that focuses on buying shares of companies that regularly pay out dividends. Dividends are a portion of a company's profits that are distributed to shareholders, usually on a quarterly basis. This strategy can be particularly appealing to those who desire a steady stream of income from their investments. Imagine that you're a shareholder in a company that has a history of paying out dividends. You own a piece of the pie, and as the company profits, you get a slice of those earnings in the form of dividends. The more shares you own, the larger your slice of the pie becomes. But how do you identify a good dividend-paying company? It's vital to look for companies with a solid dividend history. Companies with consistent and growing dividend payouts are often financially healthy and well-established in their industry. However, dividend investing is not without its drawbacks. For instance, companies can decide to lower or even stop their dividend payments if they fall on hard times. Also, the pursuit of dividends can sometimes lead investors to overlook other important aspects of a company, such as its growth potential or financial stability. A shining example of successful dividend investing is none other than Warren Buffett. His company, Berkshire Hathaway, has a portfolio packed with dividend-paying stocks. Buffett's strategy aligns with the idea of getting paid while you wait, allowing him to earn a steady income while also benefiting from potential price appreciation. Remember, dividend investing is not a get-rich-quick scheme. It's a long-term strategy that requires patience, research, and a consistent investment approach. It's about building wealth steadily over time and creating a stream of income that can serve you well into your retirement years. Dividend investing can provide a steady income stream, but it requires a keen eye for companies with a solid dividend history. Moving on, we have growth investing. Growth investing is a strategy that focuses on capital appreciation. Investors who employ this strategy seek out companies that are expected to grow at an above-average rate compared to other businesses in the market. These are often newer companies in emerging industries, tech firms, or businesses that have tapped into a unique, lucrative niche. The allure of growth investing is the potential for high returns. For instance, if you had invested in a company like Amazon or Google in their early stages, you'd now be sitting on a gold mine. But it's not just about finding the next big thing. It's about identifying companies with robust and sustainable growth potential and holding on to those investments over the long term. The pros of growth investing are compelling. First, there's the potential for substantial capital gains. Second, growth stocks can provide a hedge against inflation because their earnings are expected to increase at a rapid pace. Lastly, growth stocks often lead the market during periods of economic expansion, which can result in outsized returns. However, there are also drawbacks to this strategy. Growth stocks are typically more volatile than the broader market, meaning they can experience significant price swings. Additionally, these companies often reinvest their earnings back into the business to fuel further growth, so they rarely pay dividends. This means investors are banking solely on price appreciation for returns. The quintessential example of a successful growth investor is none other than Philip Fischer. Known for his book, Common Stocks and Uncommon Profits, Fischer was a pioneer in growth investing. He emphasized the importance of investing in well-managed, high-quality growth companies for the long term. His strategy has influenced countless investors, including the legendary Warren Buffett. In essence, growth investing is a high-reward but potentially high-risk strategy. It requires thorough research, a keen understanding of market trends, and a tolerance for volatility. But for those who can navigate its challenges, growth investing can be a rewarding pathway to achieving financial goals. Growth investing can lead to significant returns, but it's not without its risks. The fourth strategy on our list is dollar cost averaging. Now, dollar cost averaging, or DCA for short, is a method of investing where you put a fixed amount into a specific investment at regular intervals, regardless of the investment's price. This could be weekly, monthly, or quarterly, but the key here is consistency. So, how does it work? Well, when prices are high, your fixed amount will buy less of your chosen investment, but when prices are low, you'll be able to buy more. Over time, this strategy aims to smooth out the effects of market volatility, and you end up purchasing your investment at an average cost. The beauty of dollar cost averaging lies in its simplicity. It's easy to understand and implement, making it a fantastic strategy for beginners. Plus, it takes the guesswork out of timing the market, which even the most experienced investors can find challenging. However, like any strategy, it's not without its drawbacks. If the market is on a consistent upward trend, you might end up paying more on average than if you'd invested a lump sum earlier on. One successful investor who's a big fan of dollar cost averaging is none other than Warren Buffett. He's been quoted as saying, "Our favorite holding period is forever," which aligns perfectly with the long-term, consistent approach of DCA. Dollar cost averaging is a simple and effective strategy, especially for beginners. So if you're new to investing or prefer a hands-off approach, this might just be the strategy for you. Last but not least, we have index investing. This investment strategy is all about playing the long game. It's based on the idea that instead of trying to beat the market, you should aim to mirror it. So how does it work? In index investing, you invest in funds that replicate the performance of major market indexes, such as the S&P 500 or the Dow Jones Industrial Average. This means you're essentially buying a small piece of all the companies listed in that index, and as the index rises or falls, so does the value of your investment. The beauty of index investing lies in its simplicity and low costs. You're not paying high fees for fund managers to actively trade and manage your investments. Instead, you're riding the wave of the market as a whole, which historically has proven to trend upwards over time. But it's not all sunshine and rainbows. The downside of index investing is that your investment is tied to the overall performance of the market. If the market takes a hit, so does your portfolio. Yet many successful investors have thrived with this strategy. One notable example is Warren Buffett, who has publicly praised index investing for its ease and efficiency. In conclusion, index investing is a great way to diversify your portfolio and lower your risk. It's a simple, low-cost strategy that mirrors the performance of the market, making it a popular choice for both new and seasoned investors. So there you have it, 5 investment strategies that can help you grow your wealth. From the patience and discipline required in value investing to the steady income stream of dividend investing, each strategy has its unique benefits. If you're all about the future, growth investing could be your game. while dollar-cost averaging offers a methodical approach to navigate market volatility. And let's not forget index investing, a strategy that allows you to participate in the broader market performance. But remember, these are just the tip of the iceberg. The world of finance is vast and ever-changing. These strategies are not one-size-fits-all, and it's crucial to do your homework. Understand your financial goals, your risk tolerance, and your investment horizon. Seek professional advice if needed. Remember, the best strategy is the one that fits your financial goals and risk tolerance. Happy investing! Before we wrap up, if you found this video helpful, don't forget to hit the like button and subscribe to our channel, Caffeinated Money. We're dedicated to bringing you more insightful investment tips and strategies. Your feedback and support help us create more content tailored to your needs. So, if you have any questions or topics you'd like us to cover, drop a comment below. We're here to help you navigate the world of finance. Stay tuned for more, and remember, your journey to financial freedom starts here. Happy investing!